Yeah! Woo! Woo!
There's this old market adage, right? The Fed cuts rates, stocks cheer, sounds like common sense. But what if that bit of wisdom is actually, well, dead wrong? Our deep dive today is going to unpack something powerful, maybe surprisingly counterintuitive, about what a Fed rate cut really means for, your portfolio.
Exactly. And it's fascinating because our analysis, looking back over 30 years of S&P 500 performance, it really shows that simply assuming rate cuts are good is, well, it can be a dangerous assumption, often an expensive mistake, actually.
Expensive. Okay. So the immediate reaction isn't always cheers.
Often not. Frequently it's muted or sometimes even negative because you see, the cut itself often reflects some underlying economic weakness that basically forced the Fed's hand.
Right. The weakness was already there. So if that common idea is often wrong, what's actually going on then? What's happening beneath the surface when the Fed eases policy? I guess that's our mission today, right? Go beyond the headlines, understand the signal.
Absolutely. In our analysis, it reveals this crucial fork in the road for market outcomes. It's driven entirely by the reason behind those rate cuts, that distinction between preemptive action and reactive action. That's the single most important factor for what happens next in the market.
A fork in the road. Okay, this is where our deep dive gets really interesting. So what did the analysis show about these different motivations?
Well, think of it like this. You have what we call preemptive insurance cuts, like those ones back in 95, 98, 2019, maybe even the first cuts in 2024. That's when the Fed acts sort of like preventative medicine. The economy's generally stable, maybe expanding,
Right.
and they're proactively trying to head off a potential slowdown. The market tends to see this as, competent management, fine-tuning. It bolsters confidence.
Right, so that's the sort of healthy scenario. The Fed's being proactive.
Yeah.
But what about the other side of that fork?
That's the reactive emergency cuts. Prime examples. Think about the cycles starting in 2001 or 2007. These happen when the Fed is responding to something already going wrong, a recession unfolding, or maybe an acute financial crisis.
Okay, so not fine-tuning anymore.
Definitely not. These aren't seen as fine-tuning. They feel more like a desperate treatment for an economy that's already in distress. And often, these cuts actually precede continued market declines, at least in the short to medium term. It's really the market's interpretation of that first cut in a new easing cycle that sets the whole tone. It marks a fundamental shift in the outlook.
Wow, that distinction is incredibly powerful. It completely changes how I'll listen to the next Fed announcement. So, okay, let's bring it back to the listener. What does this all mean for you when you hear about the next Fed rate cut?
I guess the main lesson from 3 decades of data is pretty clear. Context is absolutely everything. That's exactly right. And the data, it shows such a stark divergence. It's really quite dramatic. So for those first cuts in the preemptive or insurance cycles, 95, 98, 2019, that initial 2024 cut, get this, the average 6-month forward S&P 500 performance, a robust plus 13.86%.
Plus 14%, almost, okay.
Because the market sees the Fed acting from strength, boosting confidence. But then you look at the reactive or recessionary cycles like 2001 and 2007, the average 6-month forward performance was a concerning minus 12.50%.
Minus 12.5. Ouch. So the cut confirms the bad news in a way.
Precisely. In those situations, the cut signals a significant problem is already here, and just lowering rates, well, it often is enough by itself to immediately turn things around. Now, 2020 was obviously a unique crisis response, kind of its own category. And for 2024, we don't have the full 6-month data yet for a complete average, but the initial cut fits that preemptive pattern.
Those numbers are really striking. Makes you completely rethink the headlines, doesn't it? So it's not just the cut itself, but the Fed's narrative around it. Are there, specific keywords we should be listening for in the FOMC statement? That's the official announcement, right?
Absolutely. You need to decode their language. Pay close attention. Are they saying they're cutting to sustain the expansion? Or maybe ensure against downside risks, mentioning more favorable inflation data? That usually points to a bullish signal.
Like a healthy tune-up.
Exactly. A healthy economy getting a tune-up. But if they justify the cut by citing things like further weakening of sales and production or deteriorating labor market conditions, maybe strained financial markets, that tends to be a bearish signal, at least for the medium term. It confirms there's an existing economic problem that made them act.
That's a really crucial breakdown of their rhetoric. Okay, but what about the bigger picture? The economic backdrop. Does inflation play a role here?
Oh, it absolutely does. A huge role. Rate cuts are most clearly bullish for stocks when core inflation is low and stable, ideally below the Fed's 2% target. That gives the Fed maximum flexibility, you see. They can support growth without worrying too much about reigniting inflation. The 2024 cuts, though, were initiated while inflation was still, above 2.5%. That presents a much more delicate balancing act for them. It's a real test of their credibility to handle both things at once.
Right, managing inflation and growth. Tricky. So for you, the listener, it sounds like having a systematic checklist is key when you hear about a cut. You need to assess the broader economic data first. Then really scrutinize that FOMC statement for the why. Identify the catalyst, and evaluate the inflation backdrop. But basically, don't just react to the headline, always dig into the why.
Ultimately, yes. Your primary task as an informed listener or investor is to look past that immediate allure of cheaper money and try to determine the true nature of the economic patient. Is this policy like a vitamin, a preventative measure for a fundamentally healthy economy aiming for sustained growth? Or is it more like an emergency room intervention, a desperate treatment for an economy that's already sick?
Is it a vitamin or the ER? A fascinating distinction. That really changes how we should understand the market's reaction.
Yeah.
What a deep dive.